Good afternoon. My name is Jim Bruinsma. I'm a member of Miller Johnson's Employee Benefits Practice Group. And I'm joined today in this lunch presentation by my colleague, Jeff Gray. And we're doing the first of two parts of a program entitled Managing Your 401k or 403b Plan. The second part of our program will be on Wednesday, May 18. There's more information about that presentation on the last slide in our PowerPoint. I want to start by talking about some beginning concepts. The most important beginning concept is to recognize that for most employees, your 401k or 403b plan is their only retirement plan. Very few employees still have a defined benefit pension plan. So it is very important that the design and operation of the 401k or 403b plan provide the best possible opportunity for employees to accumulate funds for retirement. The good news is that 401k and 403b plans can be excellent retirement savings vehicles. First, both employers and employees can contribute. We're going to talk about some of those types of contributions this morning. Second, both 401k and 403b plan have significant tax advantages. Employees can contribute on a pre-tax basis, and in some plans have the option of making after-tax Roth contributions. Second, if you're a taxable organization, your employer contributions are tax deductible. Third, funds are invested on a tax-deferred basis. And last, a participant can further delay taxes on retirement benefits by rolling over funds to an IRA or another eligible retirement plan. A downside to these tax advantages is that they are only available if the plan satisfies a large number of rules, what we call plan qualification requirements. This includes a series of non-discrimination rules. Another good thing about 401k and 403b plans is that although there are many legally required provisions, employers have many plan design choices. And we want to talk today about some options that we consider to be best practices. But it should be recognized that you can't make up the plan provisions as you go. The IRS takes the position that a plan must be administered exactly as it is written. Any deviation is viewed by the IRS as a disqualifying event that is likely to require some type of corrective action. This is true even if what you did would have been legally permissible if your plan had different provisions. Part one of this program is going to focus on some plan design issues and typical errors in plan administration. This combination of topics is intentional because the two issues are often related. As discussed, the 401k or 403b plan is the retirement plan for most employees. So there's often a desire to maximize flexibility for employers and employees. But the plan has to be administered consistent with its terms. And in our experience, some types of complexities often lead to errors in plan administration. So there are often trade-offs that need to be considered in making plan design decisions. Now let's talk about some issues relating to the design of contributions to 401k plans. Let's start with talking about the actual 401k contributions. First issue, which employees are eligible? Are we required to include everyone? And the answer is no, you're not required to include everyone. And Jeff may have a somewhat different answer when he talks about 403b plans. The only limitation is that you're not allowed to exclude somebody from automatic eligibility if they are being excluded because they're part-time, temporary, or seasonal. There is a different solution for dealing with those employees if you want to minimize their participation, but you can't have an automatic exclusion for part-time, temporary, or seasonal employees. Second, should we have a waiting period before somebody can be eligible for 401k contributions? The old historical waiting period was that an employee had to be with you for at least a year before they could join. Our experience with 401k plans is that employers are using much shorter waiting periods so that people are eligible to begin contributions soon after they join your employment. And this makes sense. The likelihood is the employee was in a 401k plan before they joined your organization, and they don't want to wait on the sidelines for a year to begin making 401k contributions again. So a shorter waiting period is good. But there you run into a problem that sometimes you have temporary seasonal employees, for example, student interns, who you'd prefer not to include in the plan. And we said we can't automatically exclude them because of how they're classified, but you are permitted to have different waiting periods for regular full-time and part-time employees and a longer waiting period for the temporary seasonal employee, the student intern, that maybe it's a 60-day waiting period for the regular full-time and part-time employee, but a year waiting period with a 1,000-hour requirement for the temporary seasonal student intern kind of employee. Another issue, will Roth contributions be permitted? Every 401k or 403b plan permits pre-tax contributions, but many of our clients now also give employees the option of Roth 401k or 403b contributions. Well, what is that? Well, a Roth contribution is one in which the contribution is made on an after-tax basis. And you say, why would an employee want to do that? And it's because under the Roth rules, if certain requirements are satisfied, when they receive the funds out of their 401k, the Roth 401k account, neither the amount of the contributions or the investment earnings are taxable. You can imagine that if you had a younger employee, say you're a manufacturing company that has a 30-year-old engineer, that the engineer may find it advantageous to make after-tax Roth contributions. The tax advantage of a contribution, of a pre-tax contribution, may be reduced because they're at the beginning of their career at that point. And on the other hand, if you make the contribution on an after-tax basis and it's invested for 30 or 35 years before it's withdrawn, all those investment earnings won't be taxable if the typical Roth requirements are satisfied. So many employers find it advantageous to have the Roth. But the Roth isn't just for younger employees. In my experience at Miller Johnson, I make all my 401k contributions on a Roth basis, which now provides a fund of assets in my 401k account that won't be taxable in retirement. It provides an opportunity for tax planning, even in retirement, that I can take out some taxable amounts and some amounts that won't be taxable. Another issue, some employers are adding what we call automatic contributions to their 401k plan. How this typically works is that a new hire will automatically be enrolled at a specified contribution amount, often 3% of pay, unless the employee opts out. So we switch the plan from being one where you have to opt in to make contributions to a plan where the employee has to opt out. Because of the inertia of employees who often don't sign up for anything, they're more likely to have additional employees begin making contributions if automatic contributions are included in the plan. Other employers are going a step further and periodically amending their plan to say that anyone who was not contributed at that time will be automatically enrolled, often again at the 3% or whatever the chosen percentage is. Once again, we want to make the employee make a conscious decision to opt out as opposed to having to opt in, because we want to encourage employees to contribute. Some employers even go a step further and provide for automatic escalation. An example would be a plan that says that if you're not contributing at least 10% of your pay, as of January 1 of each year, your contribution will be increased by 1% until you hit the 10% level. Some employers do this on a mandatory basis. Others make available to employees the opportunity to voluntarily sign up for automatic escalation. Now you say, well, aren't there chances that things are going to go wrong if we have these automatic contributions and automatic escalations? What if it doesn't get correctly implemented? This is a place where there are trade-offs. And the reason why many employers believe it's important to have these types of provisions is that academic studies show that an employee needs to have contributions that average in the range of 12 to 15% a year over their career to have enough money to have financial security in retirement. So it's important to have a plan design that encourages employees to increase their contributions so that between what the employer puts in and what they're putting in, they can save enough money to be financially solvent in retirement. Let's go on to matching contributions. Matching contributions, as most of you are aware, are contributions the employer makes based on the amount of the employee's 401k contributions. Once again, you can choose a waiting period before people become eligible for matching contributions. My recommendation is that the waiting period for matching contributions should be the same as your waiting period for 401k contributions. I prefer this approach because of the fact that when you communicate with employees about the opportunity to make 401k contributions, at the same time, you can inform them that they will receive a contribution from the employer based on the amount of those contributions. If the matching contributions require a longer waiting period, that opportunity won't be there when employees first become eligible for the 401k contribution. I understand that some employers prefer to have a longer waiting period. Sometimes that's a financial decision, but I'd say from the standpoint of encouraging employees to participate, having those two waiting periods line up makes some sense. In our 401k plans, an employer can choose to put the matching contribution formula hardwired in the plan, or they can have a provision that says the employer will make matching contributions in their discretion. Typically, we only see the formula in the plan if it's a safe harbor matching contribution, because there you have to describe what the matching formula is going to be. So most of our employers have discretionary matching contributions. But one thing you need to be aware of is that the IRS recently is requiring new requirements to be satisfied with regard to discretionary contributions. They require that the employer's board of directors adopt a resolution that approves the matching formula, including the frequency with which it's going to be made, the amount of the contributions, the employees it's going to apply to. This historically was not required, but this is a new thing from the IRS. And if you have discretionary matching contributions in your plan, this is something that you need to be aware of. Another issue with matching contributions relates to frequency. Do you make the matching contributions every pay period, or do you do it less often? For example, annually or quarterly. Obviously, the advantage to doing it every pay period is that the employee sees that matching contribution being added to their account at the same time their contributions are made. So there's a more immediate incentive for the employee. Also, the money is in the plan longer and can be invested by the employee. On the other hand, some employers want to do it less frequently, oftentimes with a they do so because they want to do it at the end of a year. And then they want to impose a requirement that the employee be there at the end of the year and have worked like 1,000 hours during the year in order to become eligible. That's an alternative approach. I think as an incentive, it is less effective, particularly if it's a discretionary contribution. But that is an option that's available to employers. But I think the ideal approach would be to do the match on a per pay period basis. Now let's talk about discretionary / profit sharing contributions. Once again, we have a waiting period decision. This is one place where we more frequently see employers require a 1-year wait before people become eligible. And because of the fact that this isn't tied to the 401k contributions in any way, but is a separate independent contribution, it probably makes sense to have a longer waiting period for this type of contribution than for the 401k or the match. Employers also frequently impose annual eligibility requirements to receive a contribution. It is very typical for a plan to state that employee has to be employed on the last day of the plan year and have 1,000 hours of service during a plan year to receive a discretionary / profit sharing contribution. There is a typical exception that's included, however, for an employee who leaves during the plan year because of the employee's death, total disability, or retirement after normal retirement age. Those employees typically receive a contribution even if there's a last day requirement. You also have choices about how that contribution is going to be allocated among the eligible employees. Historically, the most common approach has been to allocate the profit sharing contribution in proportion to the eligible compensation of the participants who qualify to share in the allocation of the contribution. But there are other options available that can result in some employees receiving a larger contribution. In permitted disparity, those employees who have compensation in excess of the Social Security taxable wage base typically receive a higher percentage contribution than those whose pay is less than the taxable wage base. And this has been permitted by IRS regulations for a very, very long time, is not controversial in any way. Another option is to use what's called cross-testing in order to permit even more disparities among different groups of employees. This is a place where non-discrimination testing is important to determine whether the type of allocation of contribution that you want to make will satisfy the non-discrimination rules. All right, let's talk about some non-discrimination rules. The starting point is, well, how do these rules work, and in whose favor is discrimination prohibited by the IRS? And the rule is you can't discriminate in favor of highly compensated employees. In our lingo, what's known as an HCE. And the HCEs are separately determined for each plan year. And you're an HCE for a plan year if you're at least a 5% owner during the prior or current plan year. And you're also an HCE if your compensation from the employer in the prior year exceeded a specific dollar amount. For 2022, if your compensation from the employer during 2021, the prior year, was at least $130,000, you're an HCE for the 2022 year. All other participants are non-highly compensated employees. One of the non-discrimination tests that needs to be satisfied, that frankly is not on the radar of many employers, are the minimum coverage tests. The minimum coverage tests are designed to make sure that non-highly compensated employees are benefiting under the plan. And there are several minimum coverage tests that can be satisfied, but the one that is most typically used is the one that's in the PowerPoint. You satisfy the test if the percentage of the NHCEs who are benefiting is at least 70% of the percentage of the HCEs who are benefiting. So if 100% of your HCEs are benefiting, at least 70% of the non-highs also have to be benefiting. On the other hand, if 80% of the HCEs are benefiting, only 56% of the non-highs have to be benefiting. 70% of whatever the percentages of the highs. Interestingly, you have to satisfy the minimum coverage test separately for each type of contribution under the plan. And different rules are used for determining which participants are benefiting. For 401k contributions, any employee who's eligible to make a 401k contribution is treated as benefiting. So if a person doesn't contribute, but they could have chosen to do so, they're still benefiting. As a result, it's usually easy to satisfy the minimum coverage test for the 401k contributions. For matching contributions, similar result. If you're eligible to get a matching contribution, if you made a 401k contribution, you're treated as benefiting. If you chose not to contribute, it doesn't matter. You're still treated as benefiting if you would have been eligible if a contribution was made. On the other hand, for profit sharing contributions, you're benefiting only if you actually receive a contribution. So it's different than for the 401k and the match. And it can be even on the match that if you have a last day 1,000-hour requirement and you left during the year, you wouldn't be treated as benefiting because you wouldn't have gotten the match because you left during the year. So minimum coverage tests are a factor in plan design and in plan administration. Other non-discrimination tests that you're familiar with are the ADP tests for 401k contributions and ACP tests for matching contributions. The ADP tests compare the average 401k contributions by highly compensated employees and compare it to the average 401k contributions made by non-highly compensated employees. They don't have to be the same number, but they have to be within a 2 percentage point difference. There is a way to avoid these tests if you're willing to make safe harbor contributions for a plan year. A detailed discussion of safe harbor contributions beyond the scope of this webinar, but it is an option that's available. But let's say that you decide that we don't want to make safe harbor contributions. It's financially not feasible for us at this time, and that's the case for some employers. The one thing I'd mention is that if your 401k contributions for HCEs are really limited by the ADP tests, my concern relates to HCEs who are affected by that, who are receiving refunds, but aren't executives at the employer. Oftentimes, the executives are covered by bonus plans and non-qualified deferred compensation plans that may not apply to these other HCEs. So these other HCEs often may feel like their retirement program isn't very good. They're not able to achieve their goals because a lot of their 401k contributions get refunded to them. So this is an issue for HR professionals to consider in the context of their company as to how do we address that issue if we're having to refund significant 401k contributions and there's a group of people who don't receive any kind of other makeup under programs made available by the employer. We also have other non-discrimination tests that apply to the discretionary and 401k contributions. As I mentioned before, if you have a contribution that's a uniform percentage of pay, that's an automatic pass. If you use permitted disparity, the rules that are based on Social Security taxable wage basis, that's an automatic pass. Cross-testing, you have to actually do the testing to see if you're going to pass, and it may affect how you do your allocation. Also, if you have a last day and 1,000-hour requirement, it could impact your ability to pass the minimum coverage test because of the fact that you're treated as benefiting under the minimum coverage rules for profit sharing contributions only if you actually get a contribution. So if you have a year where you have significant turnover, and you have a last day and 1,000-hour requirement, it could be that you fail to satisfy minimum coverage for the discretionary and profit sharing contributions. At this point, I'm going to turn this over to Jeff. He's already elbowing me and saying it's time for me to be done. So he's going to talk about 403B contributions and things that can go wrong and how to fix them. Today, we talked about plan design issues really only relating to contributions. We could have a similar discussion on many other issues under 401k plans, including distribution rules, vesting requirements, in-service distributions, loans. Are many considerations involved in all those topics as well. These were just some of the topics we chose for today, but we certainly are available to discuss those other issues with you as well. And at this point, I'll turn this over to Jeff Gray.
Thank you, Jim. Good afternoon, everyone. Like Jim said, I'll talk about a little bit about 403B plans, plan administration errors, and how to correct them. We also have a couple questions that came in already, and if we have time at the end, we'll try to cover those before we sign off. Thankfully, probably 90% of what Jim already talked about applies to 403B plans. So I just have a couple slides here on what are sort of the main differences. Number one is just the types of employers who can sponsor a 403B plan. These are really limited to tax-exempt organizations and educational institutions. That seems like a small group, but it's actually a fairly broad group of employers that can cover foundations, hospital systems, colleges, public and private schools. So we have a number of clients with 403B plans. I think the biggest difference between 403B plans and 401k plans relate to the eligibility rules for making pay deferral contributions. So employee deferral contributions under a 403B plan are subject to something called the universal availability rule. Under that rule, generally all employees must be eligible to make their individual 403B contributions to the plan. This rule doesn't apply to employer contributions, but it does apply to pay deferral contributions. There are a couple exceptions, though, to this rule. One exception is that if the employer hires someone and reasonably expects that employee to work less than 20 hours per week, that employee can be excluded from making pay deferral contributions. That rule, though, is subject to a pretty significant limitation. If the employee actually ends up working at least 1,000 hours in a specified 12-month period, you can no longer continue to apply that exclusion to that particular employee. So that employee at that point who's met that hours requirement needs to be allowed to make pay deferral contributions under the plan. The biggest issue with this, kind of the purpose for this universal availability rule is that since you have it in place, the 403B plan is not subject to the ADP tests that Jim talked about. So the non-discrimination tests that cover the disparity between the pay deferral rates for non-highly compensated employees versus highly compensated employees. However, the other non-discrimination tests that Jim talked about, including the minimum coverage test, continue to apply. And just on that point, one other thing to keep in mind too, students for, say, an educational institution, they can also be excluded. So if you've got students that are there working for you and they're students that you are at college, for example, and the students studying at your particular college, you can exclude them. I think another difference between 403B plans and 401k plans is that 403B plans, the investment lineup is more limited. There, you're limited to mutual funds and annuities. So you have a little bit less flexibility in terms of what the investments are under the plan. But carrying on here beyond 403B plans, we'll talk a little bit about errors in plan administration. These cover both 401k and 403B plans. The biggest issue I think we see, and we continue to see, is related to errors in the definition of compensation under the plan. Not necessarily the way it's written, but the difference between how compensation is defined in the plan and how it's administered on the payroll side. So when you think about a 401k plan, the amount of a participant's deferral, the amount of an employer's contribution, it's all based on the employee's compensation. So how that compensation is defined is very important. And the plan document will define it. And it will include things like bonuses, or it will potentially exclude bonuses. That's probably one of the big areas that we see in terms of a mismatch between the plan document and how the plan is administered. Either the plan includes bonuses for compensation, and administratively the employer has not included those, or vice versa. That's a common problem. And the most important part is really to have tight alignment between your payroll department and your benefits people. You want to make sure that the way that these errors often come up is that the payroll department, for example, has created a new payroll code and hasn't even thought to ask the benefits people about how it should be coded with respect to the 401k plan. Or alternatively, the benefits people have signed a new plan document with their document provider and changed the definition of compensation and not run it by the payroll folks. So the key point there is just to have good communication within the company about that definition. And when that definition is administered incorrectly, you often have to make a correction, which we'll talk about in a second here. Another common error is just the failure to enroll a new employee when the employee becomes eligible to participate. And this can happen a couple different ways. If you have auto enrollment in your plan, those auto enrollment features will explain how quickly the employee needs to be automatically enrolled after the employee gets the required notice about automatic enrollment. Or you might have an employee who just becomes eligible under the terms of the plan, but you didn't realize it and never provided that employee any information about making an election to enroll. In either of those cases, if you find out that you've failed to enroll an employee on a timely basis, you often have to correct that error by making up the missed opportunity that the employee incurred as a result of being enrolled too late. So the default rule on that is usually you have to make up half of what the employee would have deferred, plus any missed employer contributions, plus lost earnings. But there are a number of exceptions to those rules that depend often on how quickly you find the error. So for example, there's a special rule that applies to plans that have automatic contributions. In that case, if you find that you enrolled someone too late, but you catch it within 9.5 months after the end of the plan year in which they should have been enrolled, you can avoid making up that contribution that's based on what the employee would have deferred. We call that a QNEC. So that, in that case, you only have to make up the missed employer contributions and lost earnings. So that's a good advantage for automatic enrollment plans, and that exception is intended to encourage employers to adopt automatic enrollment. This issue often comes up with rehired employees. Your plan we'll go through here, and oftentimes your plan will tell you what to do. And here, this is one of those situations where either your plan indicates that a rehired employee is subject again to automatic enrollment, or it may not. What you don't want to do is just make an assumption that because someone who left had previously opted out of auto enrollment, that they continue to be effectively opted out of it when they are rehired. So check your plan document. Here are a few additional typical errors in plan administration. Failure to timely send employee contributions and loan repayments to the plan. This is still a hot button issue with the DOL. The general rule on this for employers that have, I think, 100 or more employees is that you have to send this over as soon as reasonably possible. And the DOL looks at your history in forwarding these contributions to the plan and determining whether or not you're doing it on a timely basis. So if you are able to show through your history that, say, payroll date is on a Friday, you withhold participant contributions from their pay, and you send it over on, say, the next Monday to the plan, if the DOL audits the plan, it will look at that window of time to decide whether other situations were late. So for example, you repeatedly send the money over by Monday, but then there are 6 payroll dates when you send it over a week later than that. That's the sort of issue where the DOL will want you to go back and potentially make corrections due to the failure to send those employee contributions on time. The DOL considers that a breach of fiduciary duty. And we'll talk about how to correct that in a minute here too. Failure to set us, although that error with the failure to send contributions over is becoming less and less common as we get more automatic connections between the custodian and the company. Those are sort of automated more now, I think, than they used to be. So that's helping that quite a bit. Failure to satisfy minimum coverage tests is another error. We don't see it that often, but it can happen. This can potentially be an expensive error if you were not expecting it. So Jim talked about the minimum coverage tests. If you fail that, say, with respect to an employer contribution, meaning you've had the last day worked and the 1,000-hour rule requirement, and because you applied that requirement, you fell short of that 70% rule for non-highly compensated employees. What you can do to correct that is to amend the plan, basically to add more non-highly compensated employees to that contribution, make them eligible for that contribution so that you meet the 70% rule. So you can see why that can be fairly expensive if you're not expecting it, because effectively what you're doing is increasing the number of people who are eligible for the contribution. Another issue is the failure to use or to allocate forfeitures on a regular basis. So what the IRS doesn't permit you to have this forfeiture account or multiple forfeiture accounts that just continue to accumulate over multiple years. Generally, if you have forfeitures, they need to be determined at least once every year, and then either used to pay for plan expenses or used or reallocated to participants, or potentially used to offset future employer contributions. All of those are permissible, but again, they're spelled out in your plan document how those forfeitures need to be used. What we find sometimes is that there's just maybe say a second forfeiture account that the plan administrator just didn't know about, maybe from a prior plan merger or something, that just kind of sits out there and could potentially be a problem. So be aware of your forfeitures and use them regularly. So with that background on some of the most common errors that we see, here are a few correction programs that are formally created by the IRS on the one hand and the Department of Labor on the other. The first correction program is what we call the Employee Plans Correction Resolution System, EPCRS for short. It's a 140-page dense document that the IRS issues that explains the different ways in which you can correct plan administration errors, either on your own, which is we refer to as self-correction, or with IRS approval. All of the errors that we just talked about are covered within this manual. The general breakdown in terms of whether you need IRS approval or self-correction is whether the error is significant or insignificant. And the plan provides a kind of breakdown about how you figure that out based on the facts and circumstances. But if it's something that's insignificant, you can generally self-correct it at any time. And so when I talked about making those corrections for, say, missed enrollments, that would be your typical kind of self-correction that we do. We make those employer contributions that are fully vested to make up for those, for that missed opportunity for not enrolling someone on time. The same general concept applies, say, if you had a participant who elected to defer 6% of compensation and you programmed that incorrectly and only deferred 4%. Those are all pretty similar corrections. They're explained in the program. If you do have something that's more significant or something that's something that's more significant that you need IRS approval, there's a process for submitting that request for approval with the IRS. Unlike self-correction, there's a filing fee. It ranges from $1,500 to $3,500, and I think it depends on plan size. So if your plan has at least 10 million in assets, the fee's $3,500. The advantage of going to the IRS is that when you have something that you're not sure whether you can really self-correct, so it's not abundantly clear in the rules about whether you can fully correct it, By requesting IRS approval, you can get kind of a seal of approval from the IRS on the correction so that you know that that administration error won't be a problem in an audit. That's really the whole point. Really the reason why we're doing these self-corrections and why we're asking the IRS for approval is to avoid some sort of penalty in an IRS audit. Lastly, here we have the Department of Labor correction program. This is called the Voluntary Fiduciary Correction Program. And that's generally, at least in our world, we use this program mostly to correct the error I described earlier when the plan has not remitted participant contributions and loan repayments quickly enough. So oftentimes what happens is if the plan is large enough, it will be audited by an auditor every year, by a third-party auditor. That auditor may say, hey, we found that for multiple payroll periods, you did not remit the participant funds quickly enough. And that's when we get the phone call to say, okay, how do we fix this? How do we correct it? We usually recommend using this VFCP program through the DOL. It's a pretty straightforward filing. You basically calculate lost earnings on the delay. That calculation is pretty straightforward using an online calculator. There's no fee for this correction program. You submit it, and the DOL is pretty responsive about approving these quickly. And the real advantage there is that if you've corrected it using this program, when your auditor fills out that Form 5500 attachment for you, they can check the box that says that you corrected it using that program. And since that gets filed with the IRS, it's good to have that box checked. So we recommend using it whenever you can. That is the end of our presentation. We covered a lot, I think, in 45 minutes. So thanks for hanging in there with us. I do have two questions. And so Jim, maybe you can weigh in on this. One of them, okay, I think relates to something you said. You mentioned that we can't exclude as a category part-time, seasonal, or temporary employees. And this individual would just like to know more about that and what we mean by kind of the alternative to a broad exclusion for those categories.
Sure. Yeah, the IRS allows you to exclude employees by class. For example, you could have a plan provision that says janitors are ineligible to participate. Engineers are ineligible to participate. Employees that are the WASIAC plan are ineligible to participate. But you can't have an exclusion from participation that says if you're not eligible if you're part-time, temporary, or seasonal. What they would say is that you can apply the minimum participation rules in the Internal Revenue Code and ERISA and allow them to you're required to allow them to participate if they can satisfy those requirements. So I mentioned a situation where for regular full-time and regular part-time employees, an employer may say, well, you're eligible to join the plan the first day of the quarter after you complete 90 days of employment. Not an uncommon design. But because the employer has temporary seasonal employees, sometimes student interns, we don't automatically exclude them, but we just impose a different set of participation requirements, but participation requirements that still meet the minimum standards of the law. We have a requirement that says you have to be age 21 and you have to complete 12 months of employment during which you have 1,000 hours of service. The practical impact of having that as an alternative participation requirement for a certain class of employees may be that they never become eligible, or many fewer of those employees become eligible, but at least you're not in a situation where the IRS is saying you're excluding somebody just because they're part-time, temporary, or seasonal. Our experience is that that's not going to work with the IRS, and but you can have different participation rules for different groups of employees, as long as those participation rules for all employees at least meet the minimum standards. I hope that helps. If that doesn't help, give me a call.
That's right. That's right. Yeah, I think that's exactly right. I think sometimes some plans that I've seen, the off-the-shelf type plans where you check the box, can sometimes be confusing because it will look like part-timers are excluded, but really it's got some sort of carve out in there that says, well, you know, but if they work 1,000 hours in 12 months, then they're eligible. So yeah, you just want to be careful about that issue for sure. And then another question we had is whether we think it's makes sense to reduce the waiting period in the current environment because of the Great Resignation. This individual is talking about the tremendous amount of turnover that we're seeing, and they're talking about kind of reducing that waiting period, but because of the turnover, you're going to have more administration with people coming and going from the plan. And I think that's the real trade-off. I have seen employers who are definitely doing that, reducing that waiting period in order to attract employees, but it does come with exactly that trade-off on administration.
Yeah, I think that's exactly right. And there's no right answer to this.
Yeah.
There's no right answer to this because certainly if you have a long waiting period, that becomes a negative when you're trying to recruit new talent. On the other hand, if there is a high turnover, it creates more administrative work because you have to provide them the opportunity to enroll in the plan. And once again, if the high turnover is among people who are part-time, temporary, seasonal, you could have a different waiting period for them. But those are all issues as you consider what the plan design ought to be. Because ultimately, what you want your plan to do is to meet your business objectives. You want it to be a great benefit for your employees, while at the same time not creating so much administrative work that you have to hire more full-time equivalents just to administer the plan.
Right, definitely. So this was just another follow-up question about what the rules are once again for failure to enroll a new associate. Yeah, you can just call me anytime and we can walk through those really quickly. They depend on how quickly you find the error. Generally, you have to make up for their missed opportunity, which is a combination of part of what they would have deferred and then whatever the employer contribution would have been, plus lost earnings. Whether you have to make up that employee part, like I said, depends on how quickly you find the error. The rules are kind of unreasonably complicated about the different options there, whether you catch it within 3 months or whether the participant has at least 9 months to continue making deferrals in the same plan year, or whether you have auto enrollment. All those affect that issue. So it's good to just check. The IRS also has a very good website page on this. If you check out the IRS 401k Fix-It guide, it's got a pretty good summary of those rules. So those are all the questions. Thanks, Jim.
Thank you, Jeff.
This was great. And we will talk to you all again soon for the next monthly webinar.